All right. Good afternoon, everyone. Happy New Year. Welcome 2024, which I guess in a day or so we'll be 1 month into 2024. So time flies. And Cliff, I never remember when can you stop or when should you stop saying Happy New Year? But we'll say it for a while.
Hey, it's always a happy new year in 2024, Jeff.
Absolutely. Well, thank you everyone for joining Cliff and I today. Um, we're going to do a look back at 23. We'll do a deeper dive into 2024. And see what may be ahead. As always, my name's Jeff Carbone, managing partner, founding member, certified financial planner here at Cornerstone Wealth, joined by our chief investment officer, chartered financial analyst, just a good guy, Cliff Hodge. Thanks, Cliff, for doing this as always.
Thanks, Jeff. Always a pleasure.
Well, as everybody has been, if those have been listening in, we know there's always a lot of information we're going to go over. Today will be no different. So we will go over quite a lot of information. If you miss something, you want to get more detailed, certainly reach out to Cliff or I. We're here. Also reach out to any of the advisors or anybody on the Cornerstone team. We're here for you. Couple welcomes. Want to welcome our newest addition to the Cornerstone team, the team of Sutton Wealth Management of Tampa, Florida. We officially merged with Ed Sutton of Sutton Wealth Management and his team. So we welcome Ed, Zach, Derek, Linda, Cliff, help me, is it Corinne, Cindy, and Gwen. So welcome everybody. Thanks for having joining the team and look forward to our time together. A reminder, we are recording the session, so it is also going to be posted on our Facebook, website, YouTube channel. We'll email it here in the next few days after we get it cleared with compliance, but feel free to share it with family, friends, colleagues, those that you feel may be beneficial to. Our mission, as always, provide clarity and confidence as the cornerstone of you, our clients' financial lives. Agenda. I'll start off quickly, a brief tax update as tax season started, a brief summary of the updates for 2024 with the numbers. Cliff will do a look back into 2023. We'll proceed with a little bit of a market outlook, economic look into 2024, and then really wrap up with positioning in the portfolios and where we want to go or where we are. Cliff, I'm going to start here before I hand it over to you. Just some financial updates as we turned into 2024. For 24, tax brackets remain still 10%, 12, starting at 10, going all the way up to 37%, in between 12, 22, 24, etc. Sounds like Peyton Manning on the football field, Omaha. But a big reminder, these are set to sunset at the end of 2025. We'll revert back where the highest tax rate would be 39.6%. No change in terms of the capital gains tax rates, just depending upon your income. But starting capital gains start at 0, 15, and 20% for the higher tax brackets. Also remember the additional excess tax, 3.8%, that's still there for the higher earners. Contributions to one's 401k for those under 50, you're now able to put up to $23,000. If you're over 50, like, oh, happy birthday, Andy Smith. Andy is 51. So Andy, you can put in 30,500 today. Congratulations. IRAs, Roth IRAs, 7,000 per year if you're under 50, 8,000 for those over 50. Continuing on, just the last couple things here. Annual gift. You can gift up to 18,000 per person. And again, that could be family, friends, whoever you wish, but you can give up to 18,000 per person. So 36,000 as a couple. And then the lifetime gift, and this number always drives many people, I don't know, crazy, but it is a big number with the lifetime and estate tax exclusion. It is now at $13,610,000 per person. So again, you can gift that during your lifetime or at your death. And that would mean for a couple, you're giving over $27 million if you're fortunate enough to do so, and you have your estate tax plan and your estate plan in order. but a big reminder. And this is going to be a big 24 and 25 are going to be some tremendous years in terms of working with estate planners, financial planners, team at Cornerstone. We're doing a deep dive into one's estate because these are sunsetting in 2025. All right, Cliff. People would say I've said enough, so I'm going to start moving on into the economy, and I'm not going to steal all your thunder here, Cliff. But as we look back, we could have started off with the rate discussion of 2023. How high will the Fed go? How high or how much higher could inflation go? Haven't seen those rates or inflation as high in for decades. We went into kind of early part of March, April timeframe, but we had some demise of a few large institutions like Silicon Valley Bank and First Republic, along with some others. We had the continued war with Russia and Ukraine. Later in the year, we had Hamas attack on Israel. All following that was concerns with where's this leave Iraq and China, Iran and China. Things continued, right? Markets also took a brief pause. Even the wonderful Magnificent Seven had a correction through October timeframe before we saw a more broad-based recovery and Santa Claus rally into the year end. And Cliff, with I don't know if I left anything out, but certainly volatility was out there last year and for the U.S. and the world. But wow, markets kind of shrugged it off, most of the year, and had a really strong year for the year. So enough said. Like I said that a couple of times, Cliff, but enough for me. Going to turn it over to you. Let's go back and take a look at the 2023 and then go into 24.
Thanks, Jeff. Great job teeing everything up today. There was certainly, a lot of unforeseen events happened in 2023. The list goes on and on, all the things you mentioned. They certainly were not on consensus bingo card for the year ahead, as I'm sure, much like we'll see in 2024, there's going to be things that aren't on the bingo card that do happen. And so that's why we spend so much time and energy on our process, communicating it, implementing it, improving our process to make sure that we are ready for whatever may come. Because as we said, there's certainly going to be some things that come out of left field, especially in election year, which is going to make 2024 very interesting. So we'll start, like you said, with just a quick review of 2023. One of the major themes in 2023 for markets in general were those Magnificent Seven stocks, those AI-related large cap tech stocks. They accounted for over 2/3 of the gains in the S&P 500 in 2023. On the slide, you can see the 2023 table, and then there's a 2-year look back from 2022. So really, a lot of the strength that we saw last year was just making up gains that were lost in 2022. And in fact, if you look at things like the NASDAQ, which where a lot of these growth stocks live, still negative year over year. This was as of 12/31. So we've had a pretty good month to start the year. We're likely positive now on the NASDAQ. Small cap still down 2 years, but a 60/40, right, which is the world's retirement portfolio over a 2-year basis, still negative or flat. So, there's been a lot of volatility. Volatility is going to be a theme that we think is likely going to continue, but we really have not made up any ground over the past 2 years. But that's the story from kind of a market and return perspective. But from a macro perspective, we've really seen kind of this macro nirvana environment, if you will, where real GDP growth actually ticked up 2.5% year over year real GDP growth. If you look at the Fed's preferred inflation metric, which is core PCE, if you take the last 6 months, annualize that, we're at target. We're at the Fed's 2% target for core PCE, which is great. And then we've now had 25 months of the unemployment rate below 4%. So really about as good as it gets. And the recession that everyone expected, I believe consensus, if you look at what they forecast this time last year, early recession and then strength. We thought a recession may hit later. so far it has yet to manifest. Though the risk, as we'll see, are not completely off the table. We're not all the way out of the woods. I love this slide from Morgan Stanley. Jeff, you called out a lot of these in the introduction, but the destination is certainly what we care about. When we look back and do a review, but the ride matters as well. 2023 was a volatile year. As you mentioned, the bank failures to start the year, the AI boom, a little bit of concern about overheating and rising runaway interest rates, and then finally the Fed pivot at the beginning of the fourth quarter to set off the everything rally and to finish strongly in 2024. So not how you start, how you finish, but certainly we want to be cognizant of the risks that still remain going into 2024. And one of those risks is concentration risk, no question. So, this is the chart from JP Morgan. If you look back at the market concentration of the top 10 stocks, this is the MSCI USA. You could sub in the S&P 500. It's about the same. Only other time where we've seen this much concentration risk was the tech bubble in 2000, where it was almost 35% of the index concentrated in 10 names. Now we're at about 30%, which is, predominantly those magnificent seven stocks. We just got earnings reports from Google and Microsoft. I'm seeing some alerts go off in the background here. And so, the results of these companies are certainly going to be very influential to equity markets in 2024. So we'll be watching those very closely. We mentioned, some of the exuberance, some of the optimism on AI as key drivers for equity markets. But what did not match up with the rally were the fundamentals. So if you look, this yellow line here is earnings per share year over year. And actually, I'm not pointing at it. Let me look on this screen. So we were flat. Earnings went nowhere in 2023. The rally was completely caused by multiple expansion, or PE ratios, which is the price to earnings ratio, or you think about a valuation metric of the S&P 500, and so that's all well and good. Multiples will typically lead fundamentals, but again, the risk here, our job as risk managers, is to understand that while 2023 was a great year when you look back. It was not fundamentally driven. It was more speculatively driven. And so the risk is that we are on shakier ground here going forward if the actual earnings don't play catch up to the expectations. So that's certainly something that we're going to be mindful of. That's the story for 2023. Now we'll look ahead and kind of do a high-level overview of 2024 before we dive into some more specifics. But there are really three key themes that we're watching this year. First and foremost is that we do believe that we are in a new macroeconomic regime. This period is going forward is likely going to be characterized by slower economic growth. We're already seeing that come through the system. Higher interest rates, gone are the days of ZIRP, or zero interest rate policy. Sub 3% mortgages we think are likely not gonna happen again for quite a while. Mainly driven by a higher resting heart rate of inflation, where that 2% target that we've talked about is likely more like a floor than the ceiling that it's been for the past 15 years. And while consensus is really feels very strongly about a soft landing in 2024, we still see some risks and odds for a mild recession. That could happen later in the year, perhaps even into 2025. Given some more earnings headlines here. Given the election season, right, where those who are in power likely want to stay in power and will do everything that they can to make sure that the markets and the economy are on solid footing going into the election season. And then last but not least, the third theme is, if you just look purely at the fundamentals, put aside for the moment AI and all the implications about productivity and what that could mean for the future. But if you just look at valuations and you look at actual earnings, where things are, we think that that implies, the fundamental view implies that forward-looking returns over the next 12 to 24 months are likely going to be muted, especially for stocks. Valuations are high, earnings expectations are through the roof, and certain cohorts of investors that we track are very fully positioned for higher returns, and so the risks at this point in equities are the risk reward is skewed a little bit more to the downside. So we're going to harp a lot. We do this all the time, but we're going to continue to harp on diversification, right? Not owning just 30% of your portfolio and 7 magnificent stocks, but being broadly diversified, U.S. stocks, international stocks, fixed income, alternatives. We think all are going to continue to play a key role for portfolios going forward. Jeff, did we mention that there's an election in 2024? We're already making our way through the Republican primary season. The field may have actually even been trimmed a little bit since we updated this slide just a week ago, but it looks more and more like we are on a collision course for a rematch for President Biden, former President Trump, going into the November election season, likely going to make for an unpredictable year. And so, as always, Jeff, we're going to be prepared for anything, but there's certainly no shortage of stories and market-moving narratives this year.
Well, Cliff, thank you for the reminder. I totally did not know, but when I turned on the TV or opened a paper or whatever, I did not know there was an election coming, but thank you. But no, I think a lot of when you look back, and it's funny, well, not funny, but looking at the one slide when you were talking about the Magnificent Seven, i.e. Apple, Tesla, Google, NVIDIA, the big, one of the biggest in there, Alphabet, I said Google, Amazon, right? When you look at them, there was a slide, I think it was showing 63% of their S&P return was from those 7. I remember at one point it was almost 85 or maybe even over 90% of the return for the S&P until kind of year end when it became a little bit more broader following the Fed, right? It's still a Fed drives a lot of these markets. So with all that, Cliff, so we got the election, we've got the Fed and what's next, and tomorrow we got the first Fed. Is it the first Fed meeting tomorrow afternoon? So we'll see. Not expecting a major announcement, but let's talk about what we're seeing in terms of the macro fundamental behavioral, which you've done a great job putting this together as our dashboard. Let's go into the dashboard.
Yeah, thanks, Jeff. And certainly a lot of events that are going to make predicting the markets and predicting the future challenging. So how do we navigate the unpredictable? We use a compass, right? And our dashboard is the compass that really lays out the 3 key pillars of our investment process. And unfortunately, I feel somewhat like a broken record here over the past few times that we've gotten together. Post-COVID, the world has been very different to history, but we unfortunately continue to be in a constellation that historically points to moderate returns. Even though last year was strong, again zooming out over 2 years, we haven't really gone anywhere. And trust me, I more than anyone are looking forward to a time where we've got more green on the screen here, and looking forward to meetings where we'll say, hey, really now is the time to get aggressive. But we just don't think that is still the case, right? And these are some of the reasons why highlighted on the table here. But we're late in the macro cycle. The Fed is still on a tightening campaign. They may be done, but QT, quantitative tightening, is still reducing liquidity in the system vis-a-vis the Fed's balance sheet. We've got economic growth projected to slow, inflation continuing to slow. That's that quad 4 macro regime. Didn't play out last year, but again, our models are pointing toward that as the most likely scenario in 2024. You've got valuations that are elevated, especially on the equity side. Earnings have been negative or very slow growth. Expectations for forward earnings are very high. And then you've got certain cohorts of investors, especially the retail segment, which we track, has gone from fear. Let me get over to my right screen here. fear now to extreme greed. So we're continuing to move to kind of the yellow and red segments of the dashboard. But that's, that really is how we view the world and how we think about risk, and then asset allocation and portfolio management all flow through the dashboard, which is all data driven, and gives us the ability to have a repeatable investment process that is devoid of these emotional swings. So that's more the strategic view. If we think about tactically into 2024, there are really three scenarios that we think are likely to play out, and that's part of what we do on the investment team. We understand what's priced in the markets, we understand where consensus is, and then we game out, hey, what could happen in these other scenarios? If consensus is right, that's great. That's a continuation of the Goldilocks. But what are the risks? What are the signposts? And then how can we prepare to mitigate these risks? And then we use that incoming data to provide more clarity for the likelihood of the path forward. So I mentioned the soft landing. That's where consensus currently currently lives. The other two scenarios are more of a growth reacceleration and a hard landing. So what do we mean by these? Soft landing is where growth and inflation continue to cool down without a rise in unemployment. The Fed can continue to gradually reduce interest rates. Tech stocks work in this environment. Growth stocks work in this environment. Duration on the fixed income side. The things that really worked last year continue to work in 2024, rather. The growth reacceleration, that's kind of a loosening up of these financial conditions, get animal spirits, back reaccelerating. Hiring picks up, CapEx picks up, and consumers continue to spend money. This happens, you see GDP growth reaccelerate. The Fed likely has to, reverse the pivot and start hiking again. There are some things that point to the likelihood here, like strong retail sales as a great example. In this scenario, you want small caps, you want cyclicals, you want credit, right? More things that are pro-cyclical to the economy. And then lastly is the hard landing camp. That's the recession, right? Where the slowdown, continues to manifest. We pick up some momentum in the unemployment rate. The Fed has to aggressively cut rates. They stop QT, start QE. We likely have some sort of a drawdown in the equity markets, but then a reacceleration and a new cycle, which I think is ultimately where we're going to end up at some point. So where are we? Those are the scenarios. Consensus is firmly in the soft landing camp. This is the Bank of America global fund manager survey that came out last month. 66% of folks think that we are heading for a soft landing, which is great. That's currently what's priced in. That's the optimistic scenario. Why is it so one-sided? Why is consensus so confident? Well, because to date, the economic data has really supported this view, right? So we see GDP growth coming in and actually, reaccelerating here a little bit in the fourth quarter. Inflation, this is that PCE data. Let me get my pointer on the right screen. PCE data. Inflation coming in, unemployment staying benign. So now the market can price in about almost 6 rate cuts for next year. That really is the Goldilocks, and why equity valuations are high, why credit spreads are so tight, and why the Fed is certainly becoming a little bit more confident in what they've done. Is it mission accomplished? That's the ideal scenario. We hope so, but we need to, it's great to hope for the best, but we need to plan for the worst. And so we like to focus on and highlight the potential risks to the soft landing. There are really kind of three. The first is the long and variable lags of monetary policy. This phrase coined by Milton Friedman, economist in the 80s and 90s, kind of the father of monetary theory. It's very difficult to calibrate Fed policy correctly, right? Because the economy ebbs and flows. It takes time for the impacts to flow through the channels. If you cut too early, it can lead to our second risk, which is a second wave of inflation. If you stay tight for too long, that can kind of start the unemployment cycle. So it's very difficult. One of the questions that we had before the webinar today was around our fiscal situation. We're going to hit on that here at the end of the call. But record Treasury issuance estimates are for about 1.8 trillion in net new financing for the Treasury next year. We're at record deficits outside of COVID and World War II, so there's certainly some fiscal challenges ahead that we're going to be monitoring and could certainly play into the way that the economy and the markets evolve in 2024. But I think the one data point that most has my attention, and we've talked about this on the last 3 or 4 webinars, is really all about the employment cycle, right? And so far, the employment cycle has held up really well. We showed the graphic. 2 years now of the unemployment rate below 4%, but the unemployment rate is a classic lagging indicator, right? So there's leading indicators that predict the future. There's coincident indicators that kind of happen, alongside the cycle, and then there's these lagging indicators, and unemployment and inflation are the two kind of classic lagging indicators. When we look at the leading indicators of employment, and I've called out 4 of them here, hiring, temporary employment, and the quits rate, affectionately known as the take this job and shove it indicator. No question that these things are beginning to slow. And if you think about the logical progression of what a business may do in a time of a slowdown, the first thing you're not going to do is go lay off your workforce, right? First thing you do is maybe you stop hiring. You take down those job postings that have been sitting out there for a couple of months. If you have temporary employees, maybe you furlough them. Perhaps you lay them off. You don't re-extend their contracts. Hours worked, you start cutting hours, right? And then really the last piece of the pie is when you've kind of exhausted everything else, the last lever you pull are layoffs. And so we see the hiring rate slowing, hiring expectations slowing, kind of below where we were in the in the run up into COVID. The temporary hours worked are falling. The quit rates are coming down. So again, these leading indicators are certainly starting to soften up. Doesn't mean that a recession's right around the corner, but certainly does give us a little bit of a yellow kind of caution sign, if you will, on the state of the labor market. And so we're going to be watching labor again very closely in 2024, Jeff.
All right, thanks, Cliff. I'll give you a breather, grab a little water there. When some of those slides, like the mission accomplished from the Fed, we're not even there yet, right? Reminder, the Fed funds rate currently at 5.5%. And I know Cliff, maybe when we did our last in our September or October presentation, I think that the potential for Fed drops were maybe in the 4 for next year. Then they got as high as 7. So 7, just a reminder, 7 would mean we go from 5.5 down to 3.75. That would be a drop every meeting. Doesn't seem likely. And then I think you reminded us already. Hey, Cliff, what's happening this year? Oh yeah, the election. The Fed is politically agnostic. Let's remember that's a big thing. What Powell probably does not want to do is be seen as leading into the election. So, to get the 7 is probably impossible. What could be a likely scenario? Again, tomorrow, probably unlikely to see that first rate drop, but maybe May, maybe summer after the election. So 3 or 4, probably more likely. And then, again, anybody's guess. We'll continue to watch it. I know you guys are doing a great job with the investment team, watching it every day. So, Cliff, with everything you've talked about, we've went over the outlook. Let's start going into asset allocation and portfolio positioning, as well as the implications.
Yeah, absolutely. So we'll just kind of run through the fundamentals here quickly, starting with valuations. The key takeaway here is if you look at the S&P 500, the equity markets, we're at the 83rd percentile for the S&P, meaning that over the last now 30 years, the S&P has only been cheaper than it is now 17% of the time. So we're getting up to levels that have historically been pretty bubbly. You can there's still some room to go higher here on the S&P and in growth. the NASDAQ tech stocks are certainly, at some of the peaks. Here's my pointer over here, the peaks of their valuation levels here in technology. So there's certainly some concentration risk on the equity side. We still like fixed income. We think, yields have come in a little bit. We pounded the table on bonds last time we all got together for the webinar. We still think they're attractive. We still think that perhaps even double-digit returns can be likely in a recessionary scenario for high-quality fixed income over the next 12 to 24 months. I will call out high yield. That's an area that we are certainly underweight. Spreads there are very tight. You're not getting paid to take on the credit risk in high yield. So up in quality, we like government-backed. We like high-quality investment grade, not high yield bonds. So then we look at earnings, right? Third quarter 23 was put a stop to 3 quarters in a row of negative earnings growth. Fourth quarter is projected to grow at about 3%. If that happens, then full year for 2023, my pointer, we will be flat. Then the consensus and earnings estimates are for about a 10% growth rate in 2024. 12% growth rate for 2025. That's not pictured here on the slide, but as you can see, the actuals have been negative. Perhaps we're troughing and bottoming, but then there's a lot of ground to make up to be able to grow into these valuation levels for the S&P 500. We mentioned consensus earlier, the soft landing. What is consensus expecting as far as equity returns for 2024? Pretty modest, actually. And, these are as of the end of the year. So they're actually pretty stale already. We're above 4,900 for the S&P 500. The average was for 4,833. So basically flat from here. The high 5,200s, about 5% from here. There's a wide dispersion of potential outcomes, right? That could happen. Even in consensus, you're talking about 1,000-point range between the highs and the lows, anywhere from up mid-single digits to down double digits. And consensus historically doesn't do a great job, right? Last year, consensus actually was calling for a negative year for the S&P 500, kind of the first time in the last 20 years. So we shouldn't be surprised that did not come to fruition. But again, as risk managers, we want to take in, the where consensus is, the valuations, but then also, our job is to protect our clients' capital. And so, what's a downside scenario that we think is plausible, and what could happen? This is from a group called BCA. It's a group that we use for research. They're completely independent, and they are actually the lowest on the street at about 3,500. How do you get there? Which is 3,500 is down almost 30%. So that's a very draconian outcome that we're not forecasting. But when we see that, we have to pay attention and kind of understand how that could happen. And there's really 2 things that would have to happen. So one, that forward PE ratio. Here we are today, kind of around 4,900 at 20 times earnings. Would have to go back to the normal kind of average level of 16. Right, you can see that here on the left, and earnings estimates, which as we already showed you, are up 10%. If those were to fall by 10%, which just means there's zero earnings growth in 2024, and we fall back to an average multiple, that gets us to a target of 3,500. Again, this is not a forecast, but we do have to, if you think about, again, the risk and return, so fairly modest upside, but, potentially, a plausible case where we could have some significant downside. We want to think about that in our asset allocation recommendations. We want to think about in the kinds of exposures that we're recommending and investing on behalf of our clients. And so again, I'm going to go back and I'm going to pound the table on that broad diversification. Big cap tech worked well last year. If you were all in mega cap tech, you had a great year. If not, you still had a pretty good year. But the risk is that, if these earnings, the actual earnings don't follow through to the estimates and valuations normalize, those big cap tech stocks are going to experience some pain. And so again, broad diversification, not just stocks, but bonds, alternatives, both on the liquid side and the private side, we think is going to be the best way for investors to be positioned in 2024, likely for the next 24, 36 months. And so if that happens on the equity side, which again is not our forecast, but is a plausible scenario, if that happens, bonds we think are really going to be able to resume their role as your ballast of the portfolio. So what we're looking at here, we've showed this graphic before, but different yield levels and different returns for the US 10-year. Very plausible scenario where we get double-digit returns in high-quality fixed income, which can offset some of those equity market the volatility in the equity market, if that does in fact come to fruition. Last bit of the stool for the dashboard positioning. Really the call out here is retail is feeling very greedy. A lot of folks are getting back into the pool. We track systematics, i.e. the machine. You hear us talk about the machine all the time. What are these rules-based algorithms doing? Well, right now they're pretty well loaded up on equities, right? So again, we think about the world in terms of risk and return, perhaps somewhat limited upside in stocks, more significant potential downside in stocks. So again, pounding the table on that diversification. So what does that mean broadly? We're underweight equities, but within equities, we do like large cap. We like high quality stocks. We like defensive strategies. Those are the kinds of things that will hold up in a slowdown or even a valuation normalization. We like bonds. We still think bonds, high quality bonds, are some of the best asset allocation options for investors today. We want a diversified array of income producers, kind of complementing a very core, high quality fixed income portfolio. And then we think alternatives as well. We think they did okay last year. We think 2024 is going to be a good time for alternatives, especially those. We think private credit looks really interesting, especially when you compare that to high yield. So talk with your advisors about private credit. There are some liquidity constraints, so there's always some trade-offs, but we think private credit is going to be a really interesting position for our portfolios in 2024. And then we like the diversifiers, right? Things that are not going to follow the path of equities or fixed income. They march to the beat of their own drum and can provide a nice diversification benefit. So this is, our asset allocation matrix, just kind of graphically highlighting what we mentioned: underweight equities, overweight fixed income, and alternatives. Certainly happy to talk through any of these with your advisors or with me or the investment team directly. I want to thank everyone for their time today. Jeff, I know we've had at least one question, but I'll send it back over to you to take us home here.
Yeah. Thanks, Cliff. Again, lots of information to share. Again, thank you to you and the investment team with all the hard work. A key reminder, right? It is, and we haven't said it in a while, but the 3 Ps, right? The process. You went over the Cornerstone investment process, reviewing the dashboard, why we do, there's upside, but there's also looking at what the potential downside could be, right? Planning for it, and the planning from the investment team, but also the planning from the financial advisory team with the Cornerstone advisors behind the scenes, working with you towards your retirement plan, deepening your tax plan, reviewing your estate plan, tying all of that into the investment plan with Cliff and the investment team. And then, the hardest part is the patience, right? When things are happening, we get the emotions and removing those patience because I want it and I want it now. Or why am I not getting, and then it happens and you miss it, whatever it may be, right? Process, planning, and patience continues to be a key. Cliff, we did have the one before we kind of wrap up, one question that did a couple questions, but one that I think was a key driver was and we talked about it, was Jamie Dimon had made some of his comments Well, Jamie Dimon had quite a few comments while he was in Davos, had some really interesting interview, but some was the concern that he has in terms of the deficit and the deficit rising and the ability to sustain. So I don't know if you want to just talk through that for a couple minutes as we wrap up.
Yeah, that's something that we called out here, and with the risks, I labeled it as record treasury issuance, but fiscal deficits are kind of all encompassing, the same idea. And no question, we are on an unsustainable path, right? Our deficits now are at a record outside of COVID or World War II. We cannot continue to keep spending at the same rate that we are. 1.8 to $2 trillion in net new issuance. Who's going to buy these bonds, right? Banks are pulling back. Sovereigns are pulling back to a degree. So there are a lot of concerns. There's a lot of headline risk. I think Jamie Dimon is a fantastic CEO. I think he also perhaps may have some political aspirations. So it's kind of easy to beat on that drum. Especially if you're eyeing a run of some kind, not this term, but perhaps the next presidential cycle. But one thing I pulled together and wanted to share, even though our deficits and our debt as a percentage of GDP has grown pretty significantly over the last 20 years. If you compare us to our neighbors or developed markets around the world, we're actually still in a pretty good position. So we are white here, United States. We're at about 126% debt to GDP. You look at some of our neighbors here, we're kind of right in line with France at 123. Germany looks really good at 66. No surprise, the Germans are very fiscally disciplined. But then you look at places like China at 360, Japan near 220, even the UK at about 200. We're actually still in a reasonably good position compared to the rest of the world. And when people talk about the fiscal situation, it's usually in the context of risk to the dollar as the world's reserve currency, risk to our position as the leader of the kind of the global order. And yeah, I think long term those certainly could be in jeopardy if we don't get our fiscal house in order. But it's certainly not an issue that we think is going to affect the U.S.'s place in the globe, or the ability of the dollar to continue to serve as the reserve currency. I mean, I think we've got decades, if not more. I mean, there's no substitute, right? You want to buy euros, you want to buy Bitcoin, Turkish lira. I mean, how are you going to transact? Certainly not in Chinese yuan or Japanese yen. So, the fact that there's no substitute, I think helps. What can we do in the long run? Well, we can elect politicians who stop spending money. I mean, that's a lot easier said than done. I don't know that anyone's going to sign up for that. But the other solution, which I think we're seeing play out, is our authorities are going to allow for higher levels of inflation, right? Because if debt is fixed and you're able to inflate that away via higher prices and higher nominal growth, that's a way to kind of stealth delever, right? So that plays into our thinking in the longer run outlook, that we think inflation, this regime of a little bit higher inflation, higher volatility is going to be here to stay. And so, we think about that with our recommendations and our positioning. We're not shying away from the U.S. dollar by any means. But again, we are looking at exposures, things like private credit that work in an environment that are geared more toward lenders, right, rather than borrowers. We think stocks that are more pro-cyclical, after we go through a slowdown or a recession are going to be a lot more interesting than some of these large mega cap names. We talk about it a lot, but international stocks are cheaper. So, making sure you have some exposure there as well in a broadly diversified portfolio. Those are all, things that play into how we mitigate those levels of risk. But it's, certainly not something that we make a drastic change, because there's certainly a long runway before we think this is really threatens the fabric of our country, fortunately. So, sorry, long-winded, but pretty passionate about that, Jeff.
It needs to be addressed, and like you said, maybe it's a tough one for all that are involved. But no, thanks, Cliff. Thanks for your comments there. As we close out today, we want to thank everyone for joining us. But I know I was talking with Jared and Andy, and I want to congratulate. We've got quite a few clients that have chosen and moving into their next journey in life, retiring in 2024. So congratulations on that journey in that next phase of life. I think when, again, talking with Andy and Jared, they had one client retiring from, I believe, AT&T with 52 plus years. Another, I believe, Duke Energy with about 47. I know I've got a client that I love the way he put it. He was retiring, and it's now Mark 2.0. And he is now off on an amazing trip in New Zealand and Australia with him and his wife. So congratulations to all those that are retired or retiring this year, but continued congratulations for those that are retired. So I was looking, and I wrap up with I was reading a couple articles because retirement was on my mind, not my mind for me to retire, but retirement because we had a bunch of clients. But I was reading one article that said the best retirement states are, and this came from Home and Retirement News, the top 5 states: Mississippi was number 5, Idaho number 4, 3 was Iowa, Maine was number 2, and New Hampshire was number 1. And so I was kind of surprised. So then I was reading another article, and this came from CNBC.com, and their list was a little different because maybe not totally, but their number 5 was Wyoming, followed by Delaware, Virginia, Colorado, not too surprised, and then Florida, of course, has been on that list. So when I was reading this, it made me conclude that there are so many great places to retire. It's an amazing country that we live in. We're fortunate to be part of the USA. But you individually get to decide where you want to be, or as a couple, you decide where you're going to be happiest, where your family, or you want to retire by your family or away from the family, whatever it may be. You want to be part of your community. It's your choice. It's the actions you take are your decision. The biggest thing is taking action. Worst case, change your mind, move. So enjoy retirement, enjoy life, enjoy the happiness. On behalf of Cliff, thanks, Cliff. Thanks to the investment team. Thanks to the rest of the Cornerstone team for being on and being there for us all. We thank you all for joining. Again, we'll have a replay out here probably the next day or so. Keep an eye out. Pass it along. Spread the word. We wish you all good health, wealth, and happiness in 2024. Thanks, everybody. Have a great day.